Hello and welcome to today's Insurance Nexus webinar, Customer First Cyber Insurance, Why Collaboration with Brokers and Clients is Key. My name is Gareth Ragg, and I will shortly be passing you over to our panelists and our moderator. But before then, just a few bits of housekeeping before we start today's webinar. We would like to keep today's webinar as interactive as possible. That means we want you to do some of the work too. We're not putting everything onto our panelists and moderator today, so we want you to ask some questions. If you look at your screen right now on the dial on the right-hand side, you will be able to see a chat box. In there, you can ask your questions to the panelists. We'll pass those over to our moderator, and we'll put them to the panelists in the Q&A at the end. Don't be shy. Let's put these guys under the test this afternoon and get the answers that you really want to hear. Also, before I hand over to Chris from the team, I'd like to remind you that this webinar is being held in the run-up to the Cyber Insurance USA 2019 conference, taking place on November 4th and 5th in Chicago. It's really a first-of-a-kind event and the only event in the US that will tackle the significant challenges and opportunities facing this rapidly growing cyber insurance market. It will bring together 150 cyber execs from across carriers, brokers, and technology providers to understand the evolving risk picture, pricing, and coverage, whilst always seeking to build policies and products that put the needs of the customer first. If you'd like to know more details about the event, who's speaking, the topics we're going to be covering, it's very simple to go and check it out. Simply look at the screen now. You will see the web address on there. And a final piece of housekeeping, don't worry about taking notes on today's webinar. I will be sending you a link to the recording either tomorrow or Thursday, so you can watch back at your leisure or share with your team if you think it will also be interesting to them. Final reminder, make sure you ask lots of questions. It makes for a very lively and interesting webinar. So thank you very much. That's enough for me right now. I will be passing you over to today's moderator, Christopher Frankland. Christopher, over to you.
Gareth, thank you very much. Welcome, everybody. I think this is a timely and fascinating topic to be covering, especially given the Capital One incident that I think we've all probably heard about in the news, and I'm sure we'll be discussing in some detail today. Just a quick introduction for myself. I'm Christopher Frankland. I am the head of InsurTech partnerships with Resource Pro. I'm also the founder of InsurTech 360. And as I said, really delighted to be in some excellent company today. I will let the other guests kind of do their own introductions, but we do have Kelly Castriotta from Alliance Global, Paul King from USI Insurance Services, Michael Bourne with Lockton Companies. Before we continue, guys, if you would like to give a quick intro and maybe some background about your experience in the cyberspace and why you're here today talking about it.
Sure, I'll start. This is Kelly Castriotta from Allianz. I am the Regional Product Development Head for Financial Lines in North America region, and I'm basically in charge of developing, writing the policy wording for our Financial Lines book, including cyber, which is obviously a huge growth engine in the industry.
Thank you, Kelly. Paul, would you like to introduce yourself?
Absolutely, thank you. And this is Paul King with USI. I'm Senior Vice President and the National Technical Director, which is one of the national positions within the Executive and Professional Solutions Group within USI. And what we do, Risk Solutions Group, is in our title, and that's what we provide, including the cyber risk solutions, insurance, and the related and ancillary offerings within this group. And I have been on both the brokerage and the underwriting side when it comes to cyber. So it is a topic that is near and dear to the heart today. I think some of the things that we're looking to focus on and what we're interested in cyber-wise is not just the risk transfer contract piece, but also the pre-event and the broker collaborations and the next generation cover items is what we focus on within the group in regard to cyber. So looking forward to today's discussion.
Excellent, thank you. Michael?
Yes, hi, this is Michael Bourne. I lead our cyber and technology practice out of the Kansas City series of Lockton Companies. We focus obviously on assessing our clients' cyber exposures and finding the appropriate risk transfer or insurance solutions for them. In order to one-up Paul, I will tell you that in addition to the broker side, I've been on the underwriting side, and I've run a claims team. And before that, I was in insurance defense in private practice as an insurance defense lawyer. So I've seen this exposure from a lot of different angles. And as Paul said, we're not just concerned with finding the appropriate insurance for our clients, but in truly understanding their exposures and figuring out the best risk management solutions for them.
Excellent. Thank you, everybody. And again, welcome this morning. And I think there's a lot that we can cover. But I would like to kick off with a few statistics that I think are quite eye-opening, to be frank. So a Hiscox study recently mentioned that cyber attacks against organizations have surged from 38% to 53% in the last 12 months. In addition to that, an EY Global Information Security Survey revealed that only 65% of organizations believe they have cyber insurance that meets their needs. And two recent significant legal actions indicate that as cyber threats and their risks increase, even the remaining 35% of organizations may not be adequately covered by insurance. And that's, a whole host of other statistics around the types of cyber incidents that are really increasing in nature, denial of service attacks, worm virus, ransomware, worm infestation attacks. So a whole host of cyber incidents that are really coming our way quickly and fast and furiously. So I think my first question to everybody is really around how with the pace of the types and the variations of cyber attacks and how they are evolving so quickly, how can carriers ensure that the products that are being created are robust enough and able to really evolve with the types of attacks that are occurring, and how can that be communicated through to the broker and through to the insured?
I guess I'll start. This is Kelly from Allianz. That's a great question. I think this is sort of untraditional as far as the product offering goes within the financial line space. Not only do you have policy wording that you need to make sure encapsulates the risk that you want to take on as a carrier, but you also have the whole host of services that go along with it, of course. So, on the wording piece of it, we are constantly in a position to update our wording, make sure that we are being competitive and also bringing the coverage up to speed with where the cyber attacks are developing. And if they're, pertinent to certain industries, to look at that in a new light and make sure that we are quickly responding. This is somewhat of an anomaly in the financial line space. D&O, for instance, it's pretty slow, and you don't have the innovation yet that you would have in the cyber market, which is still relatively immature. On the product side, as far as services offering, I think that's where carriers get very creative, and they need to be very competitive. So not only do you have the post-breach services, but you have pre-breach services and then remediation services. And there are a lot of carriers that are working towards bringing those in-house, and they have an in-house model. And then there are others that are just working on making sure that we underwrite to and vet the vendors whose services we're offering to our insureds, and making sure that they are the top-notch and vendors out there, and that their services have efficacy to treat the cyber risks.
Thank you.
I'm happy to be the storm cloud to Kelly's point, guys, and I think this is an important counterpoint. And Kelly's right. Unlike D&O, much more so like EPL claims over the last 2.5 years or 2 years now, and some other more emergent lines, whether they be directly tied to the financial lines or not, cyber is unique in that threat addressing piece. What I think is the kind of the downside of what Kelly's talking about is the uptake rate of these tools that have been built and created. And it is, to use a word, abysmal when it comes to clients of all sizes and shapes and class of business taking up those pre-event services, understanding who should be in charge of those things internally, who should be looped in. You know, it shouldn't just be IT or risk management or HR, it should be all three. And until the uptake rate and the understanding by both the brokers and the clients about what these services mean, what services they actually need, what services are differentiated versus the very widely offered type of services, which may or may not be better than something you could find, you know, yourself or through your existing vendors relationships. Until that happens, the ability to preemptively address a lot of these threats is still going to be, as Kelly mentioned, in its infancy and in an immature state. They're important, but the actual usage of these things to address threats before they hit the policy, it just is not there yet for several reasons.
Thanks, Paul.
And this is Michael. I just want to jump in here and say that I think that this initial topic in the discussion and just the initial two responses highlights the necessity of, you know, sort of the title of this webinar, and that's the collaboration between all the folks that are involved in this business. Right? As a broker, we see, you know, we see input from all of the different constituents. So we have our clients that are concerned about particular issues and particular exposures, but may not be aware of all the exposures they have. And then we have the insurance companies who are trying to provide appropriate risk transfer solutions as well as risk management solutions. And then we've got the IT vendors that are on the front line and are seeing the attacks as they come in and understanding, you know, the vulnerabilities and the issues that clients and companies should be aware of. And I think that in order to put all those pieces together, we have to collaborate accordingly so that we can find both the best risk management and the best risk transfer solutions.
Thank you,
guys. I think Michael makes a really good. I was going to say Michael makes a really good point, and it's very timely as well. And Kelly's point on, you know, the entirety of the organization looking beyond the risk transfer contract and looking at services, looking at being proactive. There was a case related to the, you know, speaking, and Kelly mentioned D&O and a tie-in there. It's very timely to wrap all these things in, because having a plan, as we know, you know, as you saw initially from years ago from the Wyndham test and some of the actions that came up around that breach years ago are now being echoed earlier, I believe, this month in the Delaware Chancery in regard to related to the Blue Bell Listeria, which we all are familiar with from a couple of years ago. They talked about the lack of a setup of a baseline for directors and the board themselves to be aware of risks that are inherent to their business. If it's as simple as engaging in some of these pre-breach tools, whether they be from the carrier side, whether they be things that brokers are building out, whatever the case may be, it may also be a way from a cyber risk standpoint to offset some D&O risk, i.e. that you have made yourself and availed yourself of these pre-event type of services, and that you've used them to build a plan, etc. That's what they're there for, these various offerings. And it's not just a cyber effect, but it also is a very possible knock-on D&O effect, and it's going to get worse as we go down the line. So I think that's an important piece as well to that uptake rate.
Mm-hmm.
Yeah, thank you, everybody. And I think the message there around collaboration is obviously such a key point. And I think we've seen other areas within the insurance industry. You know, we've heard a lot about automation. We've heard a lot about direct-to-consumer models and how various lines of business are starting to perhaps move in one direction. But I think cyber is undoubtedly a place which will require a lot of hand-holding, throughout the whether it's kind of on the cyber hygiene side with the clients, and all the way through to the broker and the carrier. Really kind of a very much a combined effort to hopefully make sure people are equipped with the right tools and have the right people to reach out to at the right time. I mentioned during the opening obviously the Capital One incident where obviously we had 106 million card customers personal data hacked and accessed. I think that opens up another interesting discussion around cloud and around technology that involves cloud. As we see a lot of companies moving more and more data into the cloud, what does that mean for cyber insurance, and what does that mean for perhaps the models and the products that are being built going forwards, taking into account that now you have a lot of data that is starting to reside outside of the company firewall?
So again, Kelly from Allianz, I think that I can't specifically comment on Capital One from the carrier side, but as far as the question goes with regard to cloud exposures, I think there are multiple points of aggregation from a carrier's perspective that we are concerned about as an industry, and one of those points is a cloud exposure that could be aggregated across multiple risks. So I think that concerns us, and it's one of many aggregation points that we could point to. Once you start getting into dependent BI, supply chain, and so on and so forth. But cloud providers, there are maybe three major ones, so that's always an issue. And I think carriers are always looking to explore how to manage that aggregation, whether through more specific underwriting or underwriting based on data aggregation, sort of insurance company becoming sort of a tech company, or that seems to be a trajectory that might be successful for a number of carriers who've had at least reinsurance exposure data collected over many years, or to offset it somehow with reinsurance or alternative vehicles. So that's sort of how we're viewing cloud exposures from the carrier side, and obviously it has not been so impactful to the industry where it has hardened the market whatsoever. But if we do see aggregation events that start to hit across the industry, perhaps we'll see some hardening associated with that.
Thanks, Kelly. Paul, Michael, any thoughts to add there?
Absolutely. The first thing that we say to all of our clients that are considering or have already moved a lot of their operations and data to the cloud is that you should not make the mistake of believing that by moving your data or operations to the cloud, you have transferred liability for that data and those operations to the cloud provider. That's absolutely not true. Your data is still your data, and where you choose to store it, whether it's on your own servers or a cloud server, you are still responsible for that data. And by transferring it to the cloud, you may have transferred some potential liability, or at least some responsibility for the security of that cloud provider. You're still responsible if that data should get breached. Now, you may have some recourse to the cloud provider if it was the cloud provider's security that was breached, but you can't count on that. The responsibility still rests with what we call the data owner. And what that means is you should be fairly certain that your cloud provider has sufficient security and potentially has the wherewithal and the insurance to cover a breach should that happen, since ultimately the data owner is still responsible for that.
Thank you.
Michael brings up some really great points there, and I think on that very end piece, guys, something that's important to note would be, what is that adequacy, right? When you're asking your provider, whether it be one of the big three, AWS and Azure and others and Alphabet and et cetera, but What if we're talking about a super regional, type provider, or a healthcare specialist type cloud provider, of which there are many, many out there, and they've got their $10 million limit. If half of their 5,000 customers get nailed, that limit doesn't really mean anything. It's completely irrelevant as far as evidencing adequacy. So questions along those lines are that next level to what Michael referenced there, and the Capital One piece leads into several different important but seemingly mundane type of considerations around conduct exclusionary language and carve-backs within a cyber policy, given looks like what some insider nature, at least from what we know initially of what happened here, that obviously rolls into imputation considerations within the cyber contract itself, and then of course who is an insured, whether the contract triggered and requirements were there and triggered an auto inclusion. Is there going to have to be a claim filed, or is there automatically coverage with that inclusion as additional insured? Vicarious questions, et cetera, come up there. And the other thing that, to Michael's point, and also wrapping into what Kelly was talking about, is that when you're contemplating not just the evidencing piece, but also, are there specific cyber requirements that you are putting in your contract that relate to the insurance piece? And there are some things that we do, the insurance clause from the vendor that you're asking to evidence. There are some things that we do in particular when it comes to optimizing that are those pieces that Michael was talking about risk management that tie directly into the clauses and terms and offerings within the policy. It shows how holistically these things have to be viewed from a risk management standpoint, as well as a line by line terms and conditions standpoint within the contracts.
Excellent. Thanks, guys. Great insight there. I do have a question to ask around prevention versus cure. So I think that the prevention versus cure angle it's a great stance to take, right? It makes perfect sense. But what kind of uptake has been seen from the current cyber carrier preventative offerings by clients, and what is the reason for this?
This is Michael.
As far as by clients, are we talking? Go ahead, please, Michael.
And I think that everybody will agree, because I've already heard, Paul talk about it. But the uptake rate on service offerings from whether it's the broker or the insurance carrier with regard to risk management, in other words, pre-breach risk management service offerings, is terrible. The clients are not utilizing those services for the most part that are being offered many times for free and sometimes for a discounted price from those sources. And I've talked with carriers and I've talked with clients, and I've tried to determine why is that and what can we do to make that better. Obviously, we have some clients that believe, and maybe rightly so, that they are sophisticated enough. They have their own resources and don't need those offered by the insurance carrier, but we have a whole host of other clients that could benefit from these services. I think one of the issues we have, and then I'll turn it over to others to comment as well, but one of the issues we have is that the people that we are talking to at the company that are responsible for placing the insurance product are not the same people that are responsible for finding risk management resources when it comes to IT and information security. And so there's a disconnect there. The insurance buying people may know that those services are available, but they really don't care because it's not their area of responsibility, or they really don't know who to communicate that to in order to see if there would be interest within the company to avail themselves of those services. And I think that we need to sort of bridge that gap between the insurance buyer and the folks looking for risk management services in order to improve the uptake rate.
Thanks. Anybody else like to add to that?
I think Michael's point brings up a really interesting point, and the folks that are on the line on this call, for the most part, from what I understand our audience is made up of, they understand exactly what we're talking about here. They get the offerings. They understand who they approach in various levels from the from the risk management side and from the insurance placement side. What I'm concerned with, and something that we've spent a great amount of time and will continue to do so within USI, who I could do, the only area that I can speak to where we've seen a vast deal of improvement around this and really want to continue that forward is we're not going to, the folks that are on this phone, me, et cetera, that they're not going to be in the room with 90% of clients. I mean, and it's probably a higher percentage year over year, just from a physical availability standpoint. So being able to discuss these things from the production side, from the account management side, et cetera, and really institutionalizing the kind of information that Michael mentioned is where we've seen, and I think we will continue to see, success in the uptick of those services and the uptake of those services, as well as the collaborative efforts, because you have to bring in more stakeholders within the organization that understand that there may be disconnect at the client or the prospect, and how do you address that for them with these pre-breach services. It's not going to be Michael and I in every single Kelly or whomever else in every single meeting. So therefore, spreading that knowledge can help overcome some of those issues that Michael had talked about.
I think that's absolutely right. Both Michael and Paul, I think it is a true matter of having the right people at the table and trying to express how, sort of in that silent cyber vein, that this is not just a sort of contained issue, but it's a risk management issue, it's a financial issue. So, across the C-suite sort of issue. I think another just practical matter from what I hear from brokers and what I see from the brokerage community trying to find a solution to this is that there's a labor-intensive element into, pitching the preventative offerings and then carrying it through post-sale of the insurance policies. Clients may not be aware of how to access these services, or they might fail to see the efficacy or the value. Sometimes it's an intangible value. And I think what we're starting to see is brokers and other sort of MGU and other MGUs and type vehicles sort of try to pair preventative offerings or vendor offerings with an exclusive type of insurance contract, which, these kinds of experiments are in early stages, so yet to see if they actually work. But at least a step in the right direction and thinking about it a little bit differently, and trying to get their clients to avail themselves of these services, which in turn might make them a better risk profile, et cetera, et cetera. So I think we're starting to think creatively within the industry, but it's definitely a challenge.
Thank you. Thanks, Kelly. I do have a quick question. So a lot of the conversation has been around, lack of uptake, perhaps from clients, or engagement around making sure that they have the correct cyber hygiene strategy in place. Have you seen a difference, kind of saves, small to medium business versus large organization size in terms of how engaged they are around cyber, and also do you have a different strategy around engagement with perhaps a smaller organization as compared to a larger organization?
Hey guys, this is Paul, and I would say that it's interesting. It's a good question, and if you look at the most recent statistics, and we'll just use the most recently widely available usage. I think most folks on this call would look at some of the numbers and say, in the real world, maybe they're a little bit bigger in some cases and perhaps a lot smaller in some. But if you look at the most recent IBM Poneman study, you're looking at 4 million, with an average cost worldwide, 8 million, US. And about 2.5 million for small and medium-sized businesses on average. The risk is real, and it's big for all industries. But a $8 million loss to a billion or $2 billion or $3 billion and up revenue company, isn't going to shutter them for the most part, but it may do so for a, $100 million business on a $2.5 million loss, $50 million business, et cetera. So obviously there has to be consideration of that kind of overarching factor around limit, around the applicability of terms, et cetera. So there are a lot of sublimits where they may apply, class of business, factoring in particular limits, that kind of thing that have to be taken into account. But I would be curious to see what the other panelists think. From a risk standpoint, whether it be, the two that are driving the headlines now, ransomware and phishing, and all its various types of attacks, versus some of the oldie but goldie data breach type items. These are, as Michael mentioned earlier, data owner issues on the breach side, and issues that every company is going to face through carelessness and through very sophisticated targeting, i.e. phishing and ransomware. So it's a bit agnostic, between how the risk is positioned and how we have to write and address the risks via contract, and then of course the pre-breach services or pre-event services, et cetera. But I'd be curious to see if anybody really vehemently disagrees around that. There are obviously class of business considerations like we talked about with limits and sublimits and areas of focus. But the risks that are driving the market right now are relatively size agnostic. The impact may be different, but they're out there for everybody.
Yeah, and this is Michael. I would actually take that a step further and argue that the small to medium-sized enterprise that we believe is a lower risk from a risk exposure standpoint than the large company that's got more operations and more data. I think we're seeing actually a change in that trend, and I don't have the statistics at my fingertips, but I believe that the cyber attacks on small to medium-sized enterprises has increased, and that's simply because the larger risk management organizations have much more sophisticated security protocols and are probably more difficult to breach, whereas the small to medium enterprise isn't going to have those same sophisticated protocols and are much easier targets and still have very valuable information for the bad guys. The good news is, though, from our standpoint, we're seeing smaller and smaller businesses take their cyber security posture more and more seriously and devoting more resources to it, devoting more personnel to it, and really considering risk transfer in the event that something were to happen. So that's the good news.
Yeah, I agree with both of you on this. I think the risk is relatively agnostic with regard to, small to medium enterprises. I think what's been attractive potentially to insurers is, if we go after the small, medium enterprise business, we can manage limits. We may not have to go as broad with coverage. It may be easier to build off the initial premium and, less sort of servicing. I think that's a little bit of a false belief. We're seeing small to medium businesses require the same amount of coverage in a lot of cases, and there's a lot of acquisition costs associated with trying to gain traction with those clients. They don't always buy. They don't always understand the product. They're not always equipped to sort of integrate the risk management protocols that are necessary. So it still remains really attractive business, and it's interesting how the industry is trying to sort of enter that space and gain market share. You see a lot of creativity going on with that space, and a thought that we can sort of automate the process. I don't know that I necessarily agree, but I admire the attempts to engage in that way. For sure, it makes it for an interesting dynamic. But I do think that at some level it's just as complex as these large national accounts.
Kelly, I'll just add my 2 cents there. And I think that's a fascinating comment really, because when you think about the smaller companies and organizations, I think what comes to mind is that perhaps there are packages or products which are maybe more standardized in nature, which fit the bill for a smaller organization. And as you kind of move towards the larger organizations who do have the resources to have internal security procedures, cyber hygiene procedures, which perhaps put them at an advantage. But the medium-sized companies, I think, are perhaps the ones who may not have the resources to prepare themselves for a cyber incident. Can you guys provide in that, thinking about a medium-sized company who may not have the resources available, can you provide an example of how you may help an insured prevent something like a ransomware attack?
I'm sorry, guys. Is that for Kelly?
Oh, Kelly, I mean, happy to have you have a first stab at that.
Interesting. I mean, we rely, from an Allianz perspective, we rely on the expertise of our vendors and also on the expertise of our claims people who have, been through a ransomware sort of scenario. I mean, almost exclusively relying on external help for that. Just sort of a side anecdote that might be interesting. There's been a thought in the industry that ransomware demands have been somewhat modest and manageable. But, from what we've been seeing recently, there's been, I would say, a significant increase. And I don't know if it's an aberration, but it's something that our vendor panelists are really focused in on as to how to treat these, especially in a medium-sized company or a smaller-sized company where paying the ransomware would be critical to the financials and balance sheet of that company. So I think that's pretty much all I have on this topic. Heavy reliance on the technical expertise of our vendors.
Okay. Does anybody else have anything to add there?
Yeah,
I can add about the. Go ahead, Michael.
I would just highlight the training aspect of it. Obviously, people are the weakest link when it comes to cybersecurity, and there are lots of resources out there for training of employees and staff, many of which are provided either by your broker or by the insurance company that's writing the cyber insurance. And even if they aren't provided by those folks, there are plenty of independent resources out there to provide pretty sophisticated training for your employees. And I think that is certainly one and probably the front line of defense against these types of attacks.
Last thing I'd say to echo the comments that were made there, and I 100% agree. I think it's really I can give you an anecdotal update. We've had one medium-sized client, and this is in the last 2 weeks, by the way. We've had one medium-sized client. We've had one borderline small-medium client have had ransomware events well in excess of $1 million, and one well in excess of $10 million, both of which settled out over $5 million, and that's just the ransom piece. Those limits are gone. In the case, and I think this goes to a lot of the folks on the line and something near and dear to their heart, which is it's not just buying cyber. It's buying and it's not just buying cyber based on benchmarking, which of course is static, especially in a dynamic threat environment. It's buying limit based on what is the potential impact of an APT-style attack, advanced persistent threat-style attack, that causes a ransomware event, that smoke screens exfiltration, that causes business interruption and potentially reputational harm loss, and not even getting into the language particulars around those things. What does that limit look like? Not just this is how much money was spent on a breach on average. Well, that's great. Well, do we know what parameters were factored in to the totality of that spend? Because if not, then the limits that are being recommended may very well be low. And in the situation, as we just talked about, where small and medium-sized businesses, are now starting to look at, well, we need to buy more limit. What does that limit really look like? Is a question that will be driving should be driving a lot of considerations going forward around these threats.
Thank you. I do have a question from one of the audience, an interesting one. Cyber underwriting is broken because applications are inaccurate and only a snapshot in time. Do you agree or do you disagree? And I'll open that up to you guys.
Well, that's provocative. I would say, this is, unfortunately, what the industry relies heavily on, as far as, disclosures that the insured is providing to the underwriter and a certain snapshot. Definitely, there's weaknesses in that. I think there are many ways that we can improve and that carriers are improving. Mapping to ISO controls, analyzing data, over the past 10 to 15 years or for however long your carrier's been in the business, information sharing with vendor panelists and technical experts to see where cyber threats are emerging, how they are trending. There are brokerage firms that also map they have actuaries that map the cyber exposures within the carrier's portfolio, within the portfolios of various companies. You have science, additional tools that are very much like that. There's almost so much optionality to supplement the underwriting that, yes, the applications in some way may be becoming obsolete, but there's still heavy reliance on record count, revenues, essential stuff that we do get from that mechanism as well, but yes, heavily supplemented with other reliable data, I'd say, is the trend.
Thanks, Kelly. Gents, any additional comments?
It's always interesting to try to memorialize a dynamic threat, right? Sorry, it's always interesting to try to memorialize something, and we have these practices and procedures in place at this amount of time, at this moment in time, when we're filling this out, and it's always been something it's had a little push and pull to, as I think most of the folks on this call understand. The only thing that I would really add to Kelly's point would be we also have to beware of going the other way. Well, we've got this great software-based tool that takes a look at XYZ. It's a public-facing scan. It's a header scan. I mean, some folks may have, API scans built in, and, so there may be some other levels of sophistication. But, outside of the application, going to some of the things that we're seeing now, these scans, et cetera, they're valuable, but they're, not be-all, end-all. And to Kelly's point, it really has to be a amalgamation of data points. And I think this, and Kelly, and you tell me if you disagree here, especially just on the carrier side, and I'd be curious for Michael's thoughts as well, but the area of differentiation is not really on how the policies address the threats, but how the policies are structured to address specific application type of questions and threats and things that may come in from that side that may need a different type of clause or grant. I mean, does that make sense? And obviously, I'd be curious to see what you guys think of that.
Yeah, this is Michael. There have always been questions on the application that are specific to certain types of exposures and certain coverages. It used to be that if you answered a question, in the wrong way, let's say, the carriers would be unwilling to offer certain coverage, or maybe they would sublimit certain coverage because it highlighted a potential vulnerability for that particular exposure. Here's the problem that we're running into, and it's a problem for the industry, although it's potentially a boon for companies and even brokers to some extent. And I think Kelly would agree with this. Because the cyber insurance market is relatively soft still, and that is because there's a ton of capacity. Lots of insurance carriers want to get in on the game. We are seeing the applications, the actual written applications of the required written information shrink, right? So we've got carriers now that will, if you answer 4 questions, you can get a bindable cyber insurance quote. And those carriers and many other carriers are now having to rely on other data points and other information and outside sources in order to underwrite these exposures because they're just unable to collect all the information they want to from the insured. And in fact, I think it's almost going to a place where you're having to underwrite like property and auto carriers do, and that's simply based on your analysis of the industry in general and a very few specific data points to that insured.
Yeah, I think that's a really good point, Michael. And it's sort of, I'm curious to sort of respond to your piece with a question. I'm always curious if brokers are concerned, if they're an emerging carrier with a really truncated application and not a lot of claims history under their belt, and then the pricing really aggressively, like, does that make you concerned about the viability of the book? Or, in some ways, is the application providing transparency to the broker as to how we're evaluating this risk and if we're doing it properly? I mean, I don't know too many brokers that are interested in that, but as carriers come out with more and more aggressive price modeling, I think that the modeling should be more transparent so that broker can effectively assess whether this is a viable product. Like, it might have an amazing sort of risk management part of the product and a really broad contract, but then there's from what I would imagine your perspective to be, placement of a lot of risks with this one carrier where it may not be sustainable. I mean, that would be something I would think be important.
Yeah. Kelly, to your point, and Michael, the only comment I'll make is I just would say yes, and it's because of what you both mentioned earlier, which is the aggregation risk in cyber is not industry unique, but relatively unique and rare, and the unknown elements of triggering a potential widespread aggregation event. We ID 2 or 3 things that we think would do it, but realistically, there are probably 8 or 10 that could touch off a major aggregation event across carriers. So that, combined with a non-historical claims paying or large collection of premium, et cetera, is scarier than other line considerations, at least from my point of view. I'd be curious what you think, Michael.
Yeah, and Kelly makes a good point. There are a lot of new carriers in this space, and you tend to try to grab market share by being the least frictional of the insurance carrier. So you ask those 4 questions, you provide quotes, and you try to keep your pricing as cheap as you possibly can. Lockton has a relatively sophisticated cyber and technology practice, and we tell our clients that it's not about price. We want to make sure that not only do you have the appropriate coverage in place, but that you have it with a carrier that's going to be able to pay those claims and is going to be around for a while. So that's something we consider, but we're only placing a small piece of cyber insurance, or maybe a large piece of cyber insurance, but in the overall book of business, there are a whole lot of less sophisticated buyers and less sophisticated brokers that are simply saying, well, I can have my client answer 4 questions and get them a cyber policy on the cheap. And so I think that that's going to continue to be a trend and a potential issue. I tell all my clients that applying for cyber insurance is a risk management exercise in and of itself. And so we'd like to see our clients fill out, fuller and more comprehensive cyber applications because it highlights for them the areas that they may want to improve on, and it helps us understand their exposure in a better way. It's just that, the market pressures of trying to get these quotes out the door with as least friction as possible is leading us, to smaller and smaller information gathering tools.
Mm-hmm.
That's interesting. As I know we only have about 9 minutes left on the clock, and this is a really interesting question that we just got through as well, and it brings to mind a recent lawsuit which came into play. So let me kick off with the question. So can you discuss the war terrorism exclusion and how it should be managed specific to cyber risk or alleged attacks from nation states? And the lawsuit I'm thinking of is the one I believe was Mondelez International against Zurich, where I believe Zurich had put the NotPetya attack under the war exclusion of the policy. So I wanted to get your feedback on that particular question.
This is Michael. This is an issue that's been near and dear to our hearts because as soon as the news story broke that Zurich had denied coverage based on the war exclusion, we had every policyholder on our book, contacting us to ask us if they have a war exclusion on their cyber policy and is this going to prevent them from getting coverage. First of all, I want to say that there's been a lot of misinformation on that particular issue, and the most significant piece that I would tell you is that the policy that Zurich denied coverage under was a property policy and was not a cyber insurance policy. And I can tell you that our cyber insurance underwriters have indicated almost universally to us that they would not have denied the claim based on that exclusion, even if they have a war exclusion in the policy. And in fact, many, many claims were paid on the NotPetya ransomware attacks from policies that have war exclusions. Having said that, because this issue has now been highlighted, we have to be very careful about how that war exclusion is worded in a cyber insurance policy. And I think from my standpoint, at least, and Kelly can comment from the carrier side, I think that the purpose of the war exclusion really is to prevent coverage for affirmative acts of warfare, not these, sort of cyber terrorism or, one-off or, even, state-sponsored events that are not part of either an actual declared war or what you can, seriously consider to be a warlike action.
Thank you.
Yeah, I think that's spot on. Go ahead.
Oh, go ahead, Kelly, please.
Okay. Just a quick sort of affirmation of what was just said. Same sort of issue that we're dealing with as far as the community not fully appreciating that this is a property policy in play, and that to me this speaks to more of a silent cyber issue than a war exclusion issue. But lo and behold, we as carriers are getting the request to take a look at our war exclusion. I think Michael's right. I mean, there's a recognition within the industry as far as cyber underwriters go that, there are many state-sponsored events and they're sort of on the spectrum, and whether they're, direct or causational or kinetic or, acts of declared war. I think that's where the community is struggling to sort of pin down the language to match the intent. But as Michael said, this is generally something that's accepted within the industry, that most of these attacks are going to be state-sponsored in some way, shape, or form, and that we have a cyber terrorism carve back in almost all market standard policies, which pretty heavily guts any sort of action that you would be able to take as far as declining coverage on the war exclusion. So I think that's sort of where we've settled in. I think it's interesting for those who want to investigate the issue further or track the Mondelez case. it would be interesting, and I don't think this will happen, if the court ultimately is the entity that ends up declaring what the attribution of the cyber threat is. In other words, if the court makes a determination as to whether this is an act of war or not, I think would be interesting. But I think what's more likely to happen is they probably dodge that sort of determination and make a ruling more on the ambiguity of the contract terms. But something to follow. I think there's going to be hearings commence at the end of the year for those who want to follow this.
And just 2 points on this, guys, that I think are really important takeaways. And obviously, Michael and Kelly hit it out of the park there in regard to the narrowing of the language and silent cyber being a major ancillary concern here. And up to that point, it was earlier this month. It was July 4th, so obviously the states were a little bit distracted when Lloyd's announced that they were pressing their carriers for I know it's something near and dear to Kelly's heart. They're pressing their carriers for affirmation, positive or negative, on the intent to cover cyber in non-cyber policies. This is an interesting take, and will probably bring this, and the Mondelez case will probably bring to a head the silent cyber question. And the shakeout around that will likely be significant, either way that it's decided, in regard to the property intents and other lines of coverage intent. The other thing I think is important is to keep an eye on that, and that's something that we're advising our clients on a regular basis. And then, of course, the state sponsor piece. I know everybody's talking about city, and obviously so, but the real kicker, that's a lot of personal exposure. The real kicker from a corporate standpoint, and the big focus of those on the line today, may very well be something that's going underreported in light of this, which is what appears to be a state-sponsored and Iranian tie-in to the LinkedIn phishing and spear phishing emails that are proliferating at a rapid rate. And of course, most people check their LinkedIn on their corporate networks and their places of employment. And so the chances of an incident occurring are rapidly increasing by the moment as this gambit continues. So I think those are two very timely issues to tie into the points that were made earlier.
Well, thank you. And everybody, we are unfortunately out of time. We've gone right to the wire on this one, and I think this has been a really, really interesting discussion. And thank you, Kelly, Paul, and Michael, for your time and comments. Just a reminder, there is the Cyber Insurance USA event coming up on November the 4th and the 5th in Chicago, and I think these are discussions that we could probably continue for hours. But again, thank you everybody, and to everybody who's listening, have a great week. Cheers.
Thank you.
Thanks, guys.
Cheers, guys.
Thanks, everybody.